Good morning. Good morning, all of you. Good morning.
Good morning, sir.
Yeah, thank you. Today we are going to start a new chapter. That is a statement of case flow. So it is LKAS 7. Uh, Accounting theory and standards is subject. And now we start LKAS 7, statement of case flows. And today's session we will discuss introduction part, introduction to case flow statement and different types of case flows. Here, the term case flow statement is very familiar to you all. We have studied a lot about this in the previous semesters and different subjects. And why do again we study this? So we are in we have to study this in a formal way, especially in the framework and the legal point of view, that is LKAS, Sri Lanka Accounting Standard. So what it says about uh, cash flow statement. So the previous knowledge about the cash flow statements will give you a general idea of what is cash flow statement and what are the elements in the cash flow statements, what do you mean by cash and cash equal. You may have a general idea. Now we focus on all these ideas in the viewpoint of Sri Lanka Accounting Standard LKAS 7. Right. Introduction. Users of an entity's financial statement, users like investors, most importantly the stockholders, equity shareholders. So users of entity's financial statements are interested in how the entity generates and uses the cash and cash equivalent. Very simple words, we can say, how do an entity make money? How do a company or an entity makes money? And how the entity utilize the money it makes, right? So these are 2 points: how make money and how utilize money. That is the simple way of telling this statement. Entities need cash for essentially the same reasons. You know, almost every organizations. So why do they need cash? So almost all organizations need cash, but the the reasons may differ in principles revenue producing activities, right? So there are the way of making money and utilization of money is differ among across entities. So the way of making money of bank, finance, insurance companies is different, totally different from manufacturing organizations. And even when compare the manufacturing organization and service providers, the way of case generating is all is may differ a bit at least. So so they need cash. Why do entities need cash? First, to conduct the operations. If it is a manufacturing company, so its operation is buying the inventories and convert this inventory, especially raw materials, convert the raw materials into finished goods, and they have to make sales for these activities, and it is need money. And to pay the obligations, so income tax payments, uh, interest payment, and employee wages, supplier credits. So this sort of obligations, sometimes bank, uh, sometimes organizations, entities borrowed fund from the banks. So it's an obligation of the entity to settle that. For that, the organizations need money and to provide return to the investors. Investors mean stockholders, shareholders. So they have given their money to start up the business, and they expect return from the company. And actually speaking, the return is attributable. The return is belongs to the shareholders. So when companies make profit, this profit should distribute it among the shareholders. So for that purpose, also entity needs money. And cash flows information enable the users of financial statements to assess. The cash flow statement will help the users to assess. They can evaluate the ability of the entity to generate cash and cash equivalent. Right? How the ability to generate cash, ability to make money. So, right, and the need of the entity to utilize the cash flows. So one point, the entity makes money, and another point, the company utilize the generated fund. So what are the, so we in what point of, in what views, in what activities need money? Some entities make a lot of money and utilize a small amount of money. Some companies make little money, but they may want a lot of cash. So because of it may have a lot of growth potential, it have a lot of spaces to make investments. So that is utilization. So the entity needs money to utilize. So economic decision principally, basically what, buy shares or sell shares or keep shares. This is economical decisions. So the economic decisions that are taken by users require an evaluation, right? The users, to make decisions, they have to evaluate the ability of an entity to generate cash, right? To take the decision, the users to evaluate, to assess the ability to generate, to make money, and the timing and certainty of this generation. What is the certainty? So when this company will make money, when so what is the probability of making money, whether the company is loss making company or profit making company? The generation of income is stable or fluctuate over time, whether the company is exposure, the sensitivity of exposure to the external environment. So this kind of things can be evaluated by the uh, stakeholders, shareholders, to take economic decisions. Objectives of LKAS 7. So it's a one sentence, right? The sentence has been broken into three points, right? Actually, it's a one sentence. The objective of this standard. So why do authorities develop this standard? To provide information about historical changes in cash and cash equivalent of the entity. So LK7 emphasize the management to provide information, cash flow information to the users. And how do they give that information? Using the means, the way of statement of cash flows. Right? That is a simple objective of LK7. Right? The objective of the standard is to require the provision of information about historical changes in cash and cash equivalent. Historical changes mean over the period, over the years. So what was, how the entity generate money, in 2018, how it was changed in 2019, 20, 21. So this kind of information they want. So require the provision of information about the historical changes in cash and cash equivalents. They can compare last 2-3 years and cash flow statement, and they can compare how the cash is moved across the years. So then it by means of statement of cash flows, right? The cash flow statement. So which classifies cash flows during the period from operating, investing, and financing activities. So when you look at the cash flow statement, you can find three main headings. So first heading is operating activities, cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So what are the benefits of cash flow informations? So why do we need to prepare this financial statements? So cash flow statements. Statement of cash flow, which when used in conjunction with the rest of financial statement, provide information that enables users to evaluate. Normally, the most oftenly, generally, the cash flow statement is used along with other statements like income statement and balance sheet, statement of changes in equity, like that. So when it used with other statements, it will give a meaningful information to take economic decisions. So what are the informations, right? So from that information, the users can evaluate the changes in net asset of an entity, net assets. So that net assets, it's the portion of the balance sheet that belongs to the shareholders. Net assets, total assets minus liabilities, how it change, and its financial structure, financial leverage, and solvency ratios, and asset ratios, liquidity ratios. To calculate that, when you calculate that kind of ratios, the cash flow statement informations will give more insight information and more understanding, and its ability to affect amounts and timing of cash flows in order to adapt the changing circumstances and opportunities. Business are operating in a changing environment, and this environment will give challenges and opportunities. And when they take the cash flow statements, they can understand in what circumstances, in what changing environment the companies make profit, during during which period the companies makes money very efficiently, and how much it makes money. So that kind of information will help to make decisions. So if the stockholder understand that a timing when the company makes more profit, make more money, then in that time the investors can keep the shares or make more investment on shares. The ability of entity to generate cash and cash equivalent. It's an overall idea. The ability of the entities to make money, and it enables users to develop model to assess and compare present value of future cash flows of different entities. So valuation of entity is very important to make investment decisions. This valuation largely depends on future cash inflows. This future cash inflows, the present value of future cash inflows will influence on the valuations. So ultimately, this valuation will impact on share prices in the stock market. It also enhances comparability of reporting of operating performance by different entities because it eliminates the effect of using different accounting treatments for the same transactions and events. You know, the comparability is one of the important qualitative characteristics of financial statements. For the same transactions, different entities follows a different methodologies, different methods to calculate some figures. So, for example, depreciation. Some entities, one entity may follow straight line basis, and another entity may follow uh, reducing balance method or any other method. So, these differences in accounting treatments will sometimes misguide. Sometimes it's make window dressing of the company, of the entity. To avoid that kind of misstatements, window dressings, the case flows will give an factuals, the true facts about the entity's status, and it facilitates to make comparability of the financial information across different organizations as well as different financial periods. So historical cash flows, so 2018, 19, 20, 21. Historical cash flows information is often used as an indicator of the amount, timing, certainty of future cash flows. So we can do a trend analysis. Based on the historical information about cash flows, we can predict the future cash flows. It is also useful to checking the accuracy of past assessment of future cash flows and examining the relationship between profitability and net cash flows and the impact of changing in price. Right. So when the users compare the income statement and cash flow statement, they can compare, they can understand the relationship between the profitability and net cash flows, and this profitability and net cash flows will impact on stock prices in the stock market, capital market. So that will uh, directly reflect on shareholders wealth. Now we look at some definitions quoted in LKAS 7. First, the cash. What is cash? So cash comprises the cash on hand and demand deposits, the amount of money in their hand, hard currency, right? Hard currency, and demand deposits, the account balance available in the current account, demand deposits. That's hard currency. Very highly liquidable assets. Highly liquidable assets. And cash flows. Cash flows mean the movement of cash. Cash may cash will come into the organization, and the cash or money will go out from the organization. So we so money will may inflow or outflow from the organization. So cash flows are inflows and outflows of cash and cash equivalents. Operating activities. Operating activities are principal revenue producing activities of an entity, and other activities that are not investing of financing activities. So normally we call operating activities is what? So if when you take manufacturing organizations, the operation is purchase raw materials, convert the raw materials, and make finished goods and make sales. This is the operation of manufacturing organization. The same manufacturing organization may buy some land or real estate and keep the real estate for a period of time, and they have an idea to resell the land in the future date for the purpose of getting capital gain. So that is not an operation. So in our words, we can say it's a investment activity, or we call it side business. So the main business is considered as an operating activities. When you take banks, the main operation is accept deposits from their customers, their general public, and lend that money to the borrowers, to its customers, and they earn interest income. So it's a major operation of the business of the banks. Right? Investing activities. So in addition to day-to-day business operating activities, the entities make investments for the purpose of getting extra income, additional income. So investment activities are the acquisition, the purchase, acquisition, and disposal of long-term assets and other investments not included in cash equivalents. Right? So as I told you earlier, a manufacturing company purchase land and keep the land for a period of time, and it has intention to sell the land in the future. So it's not a operation of the manufacturing company. Rather, we can categorize that this kind of activity as investing activities. Investing activity, we say is purchase, acquire some long-term assets and sell the same assets for the purpose of obtaining a capital gain. A financing activity, financing mean the source where the company, where the entity obtains money for their business, where the company are financing the money. The financing activities are activities that result in changes in size, composition of contributed equity, and borrowing of entity. So the financing, where normally entities obtain funds, so it's primarily it's from owners equity capital or shareholders equity, as well as the borrowings, the long-term borrowings from banks and other financial institutions, or from the general public through issue of debenture or bonds. So these kind of activities are categorized as financing activities. Cash equivalent. Cash or cash equivalent. What do you mean by cash equivalent? The cash equivalents are the short term. It's very essentially, it should be a short term and highly liquid investments. Highly liquid. Very quickly we can convert a particular asset into cash. So highly liquid investments that are readily convertible to known amounts of cash. Known amounts mean, so for example, we have if an entity has uh, a, a certificate, the value of a certificate of financial instruments, the value is 10,000. So the entity should confirm that when they convert this security into cash, definitely they will get the same amount appeared in the certificate, in this example 10,000. So the known amount of cash which are subject which are subject to an insignificant risk of changes in value. So there's a less chances, there is a there's less chance, there should be a less chance on reduction or changes in value. So 10,000 to 10,000 mean 10,000. So sometime it may go 8,000, 7,000, 6,000 like that, or it may go an upside. So 12,000, 11,000, 13,000, 15,000. No. So if there are changes like these due to the changes in interest rate or foreign exchange rate, so we can assume that that asset has significant risk of changes in value. In such circumstances, it cannot be considered as cash equivalents. So the cash equivalents are the short-term, highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. So from the definition of cash equivalent, there has to be four criteria for cash equivalent are identified. There are four criteria. First, they are short-term. So short-term means uh, generally is below 3 months maturity of any investment, uh, generally less than 3 months, and they are highly liquid investment, highly liquid, so very quickly can convert into cash, liquid, and they are readily convertible to known amounts. So 10,000 value of instrument can be converted into 10,000. So before convert the asset, they should know when they convert into cash a particular asset how much they can get obtained. So it's not, and they are subject to an insignificant risk of changes in value. Right? There's no much fluctuations in their market price of assets. I mean insignificant risk of changes in value. Case equivalents are held for the purpose of meeting short-term cash commitments. So why do entities keep cash equivalent? The purpose is to meet short-term cash commitments rather than for investment or other purposes. So investment, a cash equivalent, is that a cash equivalent? Investment can be considered as a cash equivalent. We have to we have to consider some points. However, for an investment to qualify as cash equivalent, so it should meet four criteria here. So there's an investment to consider a particular investment as cash equivalent. So it's readily convertible to known amount of cash. So one criteria, be subject to insignificant risk of changes in value. The another criteria, has short-term maturity for say 3 months or less from the date of acquisition. This is very important, right? The date of acquisition. The entity investments are excluded. Equity investments are excluded from cash equivalent. Right? Normally, investment in equity shares will not considered as cash equivalents unless they are in substance cash equivalents. For example, in case of preferred shares acquired within short period of maturity and with the specified redemption date. So in case of preference shares, normally uh, it has a maturity date in the absence of perpetual stock, perpetual preference shares. It means preference shares with maturity date. So if the maturity date is very near future, it's mean less than 3 months, we can consider that investment on that preference shares as cash equivalent. So bank borrowings. So bank borrowing, for example, say normally a business person use the current account, check to make to pay the obligations. They use check, and if a particular businessman does not have enough fund in their hand, he uses the bank overdraft facility. So in such circumstances, we can consider the bank overdraft as cash equivalent. So bank borrowings are generally considered to be financing activities. So normally the businesses borrowed for a long term. So that can be categorized as financing activities. But the bank overdraft facilities can be categorized as cash equivalent. However, it is cash equivalent when it's repayable on demand. Repayable on demand. So, so whenever the bank manager requests the uh, depositor, in case of overdraft, he should settle that. So it is repayable on demand. It forms an integral part of entity's cash management. Cash management